In 1982, the Securities and Exchange Commission passed a rule. It was called Rule 10b-18, and it was written in the kind of dense technical regulatory language, specifically designed to not attract attention. What it said, in plain English, was this: companies could now buy back their own stock on the open market without being charged with stock price manipulation. Before 1982, doing this was effectively illegal. After 1982, it became the defining financial strategy of the American corporation, and the consequences of that one quiet regulatory change are still reshaping the economy in ways most people never connect back to the original decision. Here's what a stock buyback actually is, because the financial press treats it as routine and boring, which is exactly how it prefers to be treated. When a company has cash, from profits from debt, from asset sales, it has a few things it can do with that cash. It can invest in new equipment, hire workers, fund research, expand into new markets, or pay dividends directly to shareholders, or it can go into the open market and buy its own shares. When a company buys back its own shares, those shares are retired. Fewer shares outstanding means each remaining share represents a larger slice of the same company. Earnings per share go up, not because the company earned more, but because the denominator got smaller. And since most executive compensation is tied to earnings per share, the people running the buyback program are also the people who benefit most directly when it works. Let that sit for a second. The executives who decide to return cash to shareholders via buybacks are also the executives whose bonuses are calculated on the earnings per share metric that buybacks mechanically inflate. This is not a conflict of interest that gets disclosed prominently. It is a feature of the system, embedded in compensation structures across virtually every major publicly traded company in America. Here is the scale of what has actually happened. Between 2003 and 2022, the companies in the S&P 500 spent approximately $10 trillion on stock buybacks. $10 trillion. To put that in context, the entire U.S. federal budget for fiscal year 2023 was about $6.4 trillion. So the S&P 500 alone returned more cash to shareholders through buybacks in 20 years than the federal government spends in a year and a half. And it accelerated dramatically after 2017, when the Tax Cuts and Jobs Act reduced the corporate tax rate from 35% to 21% and created a one-time repatriation window for overseas cash held by American multinationals. The stated rationale for that tax cut was investment. Companies would bring their offshore cash home and put it to work, hiring workers, building factories. In the 12 months after the tax cut passed, S&P 500 companies announced over $1 trillion in stock buybacks. That was a record at the time. Capital spending, the actual investment in equipment and infrastructure, rose modestly, then flattened. Wages adjusted for inflation barely moved. The cash came home. It went straight to shareholders, and the people who wrote the tax cut called it a success. Here is the historical parallel that gives this story its full weight. Before 1982, the American corporation operated under a different set of norms. The dominant model, shaped by the post-war economy, was stakeholder capitalism. The idea that a company's obligations ran not just to shareholders, but to workers, customers, communities, and the long-term health of the business. It was imperfect. It was often self-serving and paternalistic. But under that model, U.S. corporations reinvested a much larger share of their profits into the business itself. Research and development spending was higher as a share of revenue. Worker wages tracked productivity more closely. Companies carried less debt because they didn't need to borrow to fund shareholder returns, while also funding operations. Then the 1980s arrived, and with them a new ideology. The economist Milton Friedman had argued in 1970 that the sole social responsibility of business was to increase profits for shareholders. That idea, once considered fringe, became doctrine. Business schools taught it. Boards adopted it. The SEC formalized it with Rule 10b-18 in 1982. And the American corporation began its 40-year pivot away from investment and toward extraction. Because that is what buybacks are. At their core, they are a mechanism for extracting cash from a corporation and delivering it to current shareholders, at the expense of future investment, future hiring, and future growth. They are the corporate equivalent of eating the seed corn, and the people who benefit are not random. In the United States, approximately 90% of all stock market wealth is held by the wealthiest 10% of households. The top 1% alone hold about 54% of all equities, which means when a company spends $10 billion buying back its own stock, the benefit flows overwhelmingly to the people who are already wealthy enough to own significant amounts of that stock. Workers at that company, many of whom own little or no equity, see nothing from the buyback, and in many cases see layoffs, benefit cuts, and wage stagnation while the buyback program is running at full speed. This is not hypothetical. It is documented across industry after industry. Boeing spent approximately $43 billion on stock buybacks between 2013 and 2019, the 6 years leading up to the 737 MAX crisis. During that same period, the company was cutting engineering costs, outsourcing safety, critical software development, and running a regulatory approval process that internal employees were openly raising concerns about. After 2 crashes killed 346 people, and the fleet was grounded globally, Boeing needed a federal bailout to survive. The $43 billion that went to shareholders in the preceding 6 years was gone. The risk stayed with the workers, the passengers, and the public. Intel spent over $100 billion on buybacks between 2011 and 2021, a period during which its competitors, particularly Taiwan Semiconductor, were investing aggressively in next-generation chip manufacturing capacity. By 2024, Intel was losing ground in its core markets, laying off 15,000 workers, and announcing emergency restructuring plans, while Taiwan Semiconductor dominated the advanced chip market that Intel had chosen not to invest in because the cash was going to shareholders instead. Now here is the part the defenders of buybacks will bring up, because there is a real counterargument, and it deserves to be addressed honestly. The counterargument is, if a company has no good investment opportunities, returning cash to shareholders is the rational, efficient thing to do. Better to let investors redeploy that capital into higher growth opportunities than to have management waste it on bad acquisitions or vanity projects. And that argument is not wrong in theory. There are genuinely cases where a company has more cash than good uses for it, and a disciplined buyback program is better than a poorly considered acquisition. The problem is that is not how buybacks have worked in practice. In practice, buybacks surge when stock prices are high because that is when companies have the most cash and the most confidence, and buybacks slow or stop when stock prices fall, which is the opposite of what a rational capital allocation strategy would do. A rational buyer buys when prices are low, not when they are high, but buybacks are not primarily about rational capital allocation. They are primarily about hitting earnings, per share targets for the quarter, for the year, for the compensation cycle, which means the companies spending the most on buybacks are often buying their own stock at or near its most expensive, destroying the value of each dollar spent relative to what that money would do if markets were at a trough. Here is the uncomfortable truth. The buyback era did not happen by accident. It was enabled by a regulatory change in 1982, accelerated by a tax structure that made buybacks more attractive than investment, and sustained by executive compensation systems that rewarded the people making the decision with the very outcome their decision produced. It transferred trillions of dollars from American corporations to their existing shareholders over 40 years, compressing wages, reducing reinvestment, and hollowing out the industrial base of an economy that is now paying the price for those choices. And the next time a company announces a multi-billion-dollar buyback program, the thing to ask is not what the stock will do tomorrow. The thing to ask is what they are choosing not to build, who they are choosing not to hire, and what research they are choosing not to fund, so that the earnings per share number looks better this quarter. Because that is the trade being made. It is just never described that way in the press release. Drop your take in the comments. Do you think buybacks are legitimate capital allocation or legalized financial engineering that benefits executives and wealthy shareholders at the expense of workers and long-term investment? Because the data points in a pretty clear direction, but the people running the programs would like you to believe it is considerably more complicated than that.